You're about to sign a loan for 2 crores. You've negotiated the interest rate down from 12% to 11.5%. You feel like you've won, but what you've actually done is fallen for the oldest trick in the banker's playbook. You just judged a car by its paint color while ignoring the fact that the bank has kept the keys. Securing a business loan in India feels like the finish line. After weeks of pitches, projections, and paperwork, the money is finally approved. It feels like a validation of your vision. But this is a dangerous illusion. That moment of approval isn't the finish line. It's the starting line of a high-stakes negotiation where you are, by default, at a severe disadvantage. Most founders fixate on one number, the interest rate. This is a strategic blunder. The real danger isn't the rate you see, it's the architecture of control buried in the hundreds of clauses you skimmed. A system I call the lender's leash. This leash is a set of contractual tripwires and operational handcuffs meticulously designed by seasoned legal teams to transfer all meaningful risk from the lender directly to you. So while you're celebrating that 2 crore rupee infusion, clauses you barely glanced at are quietly giving the bank the power to dictate your business decisions, seize your personal assets, and even call the entire loan due on a technicality you didn't even know existed. This isn't just about avoiding a default when you can't pay. This is about preserving your freedom to operate when you can. Consider a real case. A fast-growing Bengaluru e-commerce startup. They secured a substantial loan. They were profitable. They were paying their EMIs on time. But buried deep in their agreement was a vague clause, the material adverse change clause, a classic tripwire. When a new government regulation caused a temporary 2-month dip in their revenue, the lender pulled the trigger. They activated the MAC clause. They declared a technical default, and they demanded immediate repayment of the entire loan. The founder was making his payments. It didn't matter. The leash tightened. A profitable, growing venture was forced into a fire sale, selling its assets for pennies on the rupee. This wasn't bad luck. It was a failure of strategic due diligence. The founder negotiated the interest rate, but he surrendered control through the fine print. So let me ask you, how many of those same tripwires are in your loan agreement right now? Do you even know where to look? A loan agreement isn't something you just sign. It's a system of control. And like any system, it can be deconstructed, it can be understood, and it can be negotiated. Forget the generic advice to read the fine print. That's useless. I'm going to give you a system, a proprietary framework for identifying and neutralizing these traps. This is the lender's leash protocol. Phase 1. The cost illusion. The first phase of the protocol deals with pre-signature traps. This is where lenders obscure the true financial burden of the loan. Amateurs compare interest rates. Pros compare the total cost of debt. The trap is simple. You see a 12% interest rate and compare it to another bank's 12.5%. You choose the 12%. What you missed were the hidden costs. First, processing fees. Typically 1 to 2% of the loan. That's 1 lakh to 2 lakhs on a 1 crore loan that you pay upfront before you even use the money. Second, prepayment penalties. This is a fee for being successful. If you raise a better round of funding and want to pay the loan back early, the bank charges you a penalty. This traps you in their ecosystem. Third, exorbitant late payment fees. Not just interest, but punitive charges that can spiral out of control. And finally, my personal favorite, legal and due diligence fees. You are literally paying the bank's lawyers to write a contract that is designed to work against you. Your strategic action is simple but non-negotiable. Build a spreadsheet, calculate the true total cost of debt, then negotiate every single fee, especially the prepayment penalty. Demand its complete removal. A lender unwilling to remove it is betting against your success. Phase 2. The operational handcuffs. Phase 2 is where the lender moves from your wallet to your boardroom. These are the post-signature covenants. Covenants are promises you make about how you will run your company. They are the most insidious part of the lender's leash because they destroy your most valuable asset, your agility. They aren't presented as restrictions, they're called standard protections. First, you have negative covenants. the thou shalt not list. This is where the bank can prevent you from taking on any additional debt from anyone else, selling key assets without their permission, crippling your ability to pivot, paying dividends to your shareholders, including yourself, or even changing your core business model. Then you have affirmative covenants, the thou shalt list. These clauses force you to maintain specific financial ratios, like a certain debt-to-equity ratio. This might be perfectly fine for a stable company, but for a startup in a high-growth phase, it can be impossible to maintain, creating a technical default. Your strategic action here is to become a fortune teller. Scrutinize every single covenant through the lens of your 3-year plan. If a covenant blocks a potential future action, like raising another round of debt or selling a non-core asset, it must be negotiated. Propose less restrictive versions. Instead of no additional debt, negotiate no additional debt exceeding 50 lakh rupees without lender consent. Your goal is not just to get the money, it is to retain your freedom to operate. Phase 3, the nuclear option. Phase 3 is the ultimate trapdoor, the default and seizure triggers. This is where the lender defines what constitutes a default. And I promise you, their definition is far broader than you simply missing an EMI. The moment a default is triggered, an acceleration clause activates. This gives the lender the right to demand immediate repayment of the entire outstanding loan. The trap is that the definition of default is intentionally, strategically broad. You have technical defaults, which we saw in the Bengaluru case. Breach a minor covenant and you can lose your company. You have cross-default clauses. This means if you default on any other loan from any other institution, this loan also automatically goes into default, a domino effect. And then you have the most dangerous clause of all for a founder, the personal guarantee. This clause dissolves the legal wall between you and your company. The limited liability protection of your private limited company vanishes. When the business can't pay, the lender doesn't stop at the company's assets. They come for your family home, your personal savings, your children's education fund. As Indian courts have repeatedly upheld, this is not a formality. It is a personal financial guillotine. Your strategic action here is absolute. First, narrow the definition of default. Fight to limit default to non-payment of dues only. Second, demand a cure period. Insist on a 30-day grace period to fix any non-monetary breach before it can be declared a default. And most importantly, fight the personal guarantee. This is non-negotiable. Try to have it removed entirely. If they refuse, cap the liability to a specific amount. If you absolutely must sign an unlimited guarantee, you must understand that you are betting your entire personal net worth on the success of this business. A loan agreement is not a document you sign, it is a strategic partnership you architect. By shifting your focus from the headline interest rate to the architecture of control to the lender's leash, you fundamentally change the game. Using identify the cost illusions in phase 1, you can negotiate the operational handcuffs in phase 2, and you can diffuse the nuclear options in phase 3. This is how you ensure that debt becomes a tool for growth, not a trigger for destruction. You've just learned the theory behind the lender's leash, but theory doesn't protect your home. Action does. You now have the framework to analyze the lender's leash, but identifying these clauses in a dense 50-page legal document is the next critical step. It requires precision. That's why I've built the loan agreement de-risking audit. It's not another video. It's a step-by-step digital guide that walks you through your own loan document. It helps you calculate the true cost, score the restrictiveness of its covenants, and pinpoint the hidden nuclear options we discussed today. Theory is for the classroom, action is for the arena. Stop feeling overwhelmed by legalese and start building leverage. The link is in the description below. You can get the clarity and confidence you need to protect your future. Click the link and get your audit now.